Welcome to the Leaders Insights podcast. Today's episode, M&A valuation traps CFOs keep falling into and how to avoid them. Most M&A deals fail quietly, not loudly, and the autopsy usually points to the same place, the valuation model. My guest today is a seasoned CFO who has sat across the table on both sides of over 30 transactions. Let's get into the specifics of where these models break down.
The single most common error I see is treating the discount rate as a fixed input rather than a live variable. You build your DCF in month 1 of diligence, you lock in a WAY CCC of, say, 8.2%, and then rate conditions shift, the capital structure of the target changes, and nobody updates the model. By the time you close, you're pricing a 2026 asset using 2025 assumptions.
How much does that distortion actually move the needle on enterprise value?
Meaningfully, a 150 basis point error in WACCC on a deal with 10 years of projected cash flows can swing enterprise value by 18 to 22%. On a $500 million transaction, that's $90 to $110 million of mispriced risk sitting quietly in your spreadsheet.
The synergy line is where deals get sold internally. Is that where the real fiction lives?
It's where the optimism concentrates, yes. The classic trap is what I call synergy front-loading. You model 80% of cost synergies landing in year 1, when the integration reality is closer to 30%. We saw this very visibly with the Nippon Steel pursuit of U.S. Steel in 2025, where the integration timeline assumptions were fundamentally disconnected from the regulatory and operational friction that actually emerged.
What about working capital? That seems like an area where buyers consistently leave money on the table.
Almost universally mishandled, most teams define the working capital target as a trailing 12-month average, but they don't normalize for seasonality, customer concentration, or, critically, supplier payment terms that the seller has been stretching in the run-up to the sale. I've personally unwound deals post-close where the working capital peg was off by $40 million because nobody stress-tested the accounts payable aging properly.
So due diligence is finding problems, but the model isn't being updated to reflect what diligence finds.
Exactly. There's a structural disconnect between the diligence workstream and the financial model. The legal team finds something, it goes into a risk register, and it never makes it back into the valuation. You need a CFO who owns the model as a living document through the entire process, not a financial model that gets handed off to a junior analyst in week 2.
PwC's 2026 M&A Outlook data flags that nearly 60% of deals that missed their year 2 EBITDA targets had valuation models that were not revised after initial diligence. That's a structural problem.
And the fix is institutional, not technical. The model has to be owned at the CFO level with a formal refresh cadence tied to diligence milestones.
One thing CFOs should do before they open the next data room?
Define your model governance protocol before diligence starts. Decide who has right access to the valuation, when it gets updated, and what diligence findings automatically trigger a revision. Do that first, and you've already avoided half the traps we've been discussing.
To go further, Leaders Insights offers strategic training programs, diagnostic tools, and an executive self-assessment designed for CMOs, CDOs, CFOs, and leaders, aiming for board-level performance. Explore everything at mba-training.com. Thank you for listening to the Leaders Insights podcast. See you tomorrow for another episode.